So today we're just going to, can you can hear me on, online? Joanna, give me a
Yep.
thumbs up. You can hear me?
We can hear perfectly, Matt.
Awesome,
That's the
perfect.
second, yeah.
Okay, thank you.
Let me know if you need anything.
Thank you. If anybody that's on your computer, obviously, if you guys can Google, Fed rate hike and just, it was supposed to come out, or they made their announcement at 11 o'clock today, which was just 6 minutes ago. So I don't know if you guys are going to see anything published yet, but we're kind of hoping for a 3/4 increase, and I'll kind of explain that as we go forward. But 3/4 increase by the Fed, again, should have been announced just a few minutes ago. I'm not seeing anything yet on my phone, but
0.75.
did they do it 0.75?
Yes.
Okay, that's good. That's good, and we'll talk about that. So really, what we wanted to go over is inflation, how that's affecting your business and my business. We're going to talk about the recession, and then we're going to talk about some seller buy down options. So I'm really excited about the seller buy down options. I'm excited to show you guys that. I think you'll get a lot of value off of that. And yeah, so I just went, again, I went old school and I printed off the PowerPoint. So let's just start flipping through that. So the intro is, I just kind of thought this was funny. They printed 8 trillion, gave you 1,400, sent the rest of their friends and left you with inflation. I just kind of thought that was funny. So the definition of inflation, I think we all kind of understand. It's the cost of things increasing. The cause, I think we all understand the cause of that. The supply shortage. Obviously, Ukraine has played a role in that. The oil, obviously everything needs to get transported, right? So the cost of everything is going up. Oil is kind of the driver of that. The cost of transporting the goods. The consumer price index is kind of the way to measure that. Okay. The CPI came out last week, higher than expected. And that's just kind of created more fear in the market. So when it comes to CPI, that's just kind of the main thing that investors look at. We're expecting CPI to continue to increase until the fall. Okay. And the reason is it's a year-over-year average. Okay. So if you then go back and if you look at that full year of the monthly increases that they've announced, you're going to see that if you go back to June, July, and August of 2021, those were very low inflation months. Okay, we're talking 0.2, 0.3, 0.4%. Okay, well, those 0.2, 0.3, and 0.4%, those lower percentages are going to fall out of the equation and be replaced with numbers that are closer to 1, right? Because that's kind of what we're seeing right now. We're seeing 1%, close to 1%, on a month-over-month basis, right? So when you take those lower numbers out of the equation, the CPI number can only go one direction, and that's up. Okay. But now when you get into September, October, November, that's when these inflationary numbers really started to heat up. So that's where you're going to see that CPI number really start to level off in the early fall, because again, those the summer months are going to fall off. Okay. So that's really, if you guys understand that, that's really as simple as it gets, because markets are speculative. Markets are based on emotion. So when they see those numbers, they don't dig in. They just see the headline number. Okay. And markets react off of that. But again, the low numbers from the summer months, those are going to fall off. And that's why we're going to see it, peak. You might hear the media, start talking right now about it peaking. It's not peaking. It's not peaking if you dig into it and you see that those numbers are going to fall off. I didn't advance the screen, did I? Okay. Okay, sorry, I forgot to advance the screens there. Okay, so that's Anybody have any questions on that? So based on that info, I would, no, I got it. Thank you. So based on that, I would expect, based on where we're at now, and I would expect rates to climb a little bit further. Okay. How much further? It's hard to say, but we're right on, we're at 6% now. So are we going to go to 7? It's obviously possible. I don't think we're going to edge that high. But it's definitely possible. And everyone's, loan scenario is different based on their credit scores and their down payment and that type of thing. So, so there are going to be some programs where people are there's some programs where people are already in the 7s, but those aren't your typical, higher credit scores, 20% down, that type of thing. So, okay. So inflation, basically in the 70s and 80s, we had a huge oil spike in price. And that's where we saw huge inflation numbers. And that's what we're seeing right now, right? So we're seeing a big spike in oil. Obviously, you've all seen it at the pumps. And that's really the driver of it right now. So I'm going to kind of skip through some of these. Feel free to read these. Inflation in the 80s versus now. Next one, this slide I thought was very interesting. So, so the pink is basically levels of inflation, the pink bars. The green is wage growth. And you're going to see that, after the recession, you're going to see rates come down. Okay. Number one thing right now that this graph doesn't fully show is wage growth. Wage growth is actually very strong right now, which comes into the affordability factor, which we'll talk about in a little bit. But, most of these slides, guys, are just, it's for you to, talk to your clients about some of this stuff. And, what we're seeing right now in rates is temporary. And it might be a really, really, really good opportunity for your buyers, which we'll cover again. So when will it go away? Well, I mean, the government, can continue to increase the money supply, which they're not. They're actually pulling money out of, out of the economy, which is going to basically lead us into an inflation. So, or lead us into a recession. Obviously, they printed a ton of money in 2020. If you look at this graph here, so you can see in 2020 that was the start of COVID, and there was a lot of money printed and given out, and we're basically we're dealing with that now, right? We're dealing with the ramifications of freely printing funds. Next slide is just basically a history of mortgage rates. You can see, so this one didn't print out in color, but basically these gray bars, essentially, those are that's the recession period. And then you want to look to the right of that to see what rates did basically after the recession. Okay, so in every issue and every time, actually, if you even go back to the 30s, you'll see that mortgage rates have come down, shortly after a recession. There's not you'll see that there's a time lag there, which varies. Sometimes it's a few months, sometimes it's a couple of years for those rates to come down after the recession. Okay. So mortgage rates in 2022, this just kind of shows you in January, they're in the low 3s. So, today, this chart's a little bit old. So, I mean, today they're 6. So, I mean, they've come real close to doubling since the beginning of the year. So that's the biggest, fastest jump that we've seen in rates in history.
What is it today with the recent Fed hike?
Well, again, everyone's situation is different, right? Credit score, down payments, loan program. So they're right about 6%. You know, if you got, you know, a 30-year fix with somebody putting, you know, 5 to 25%, you know, with good scores are going to be right about 6%.
Yeah, did you receive samples?
So, did
All right. So this next slide is kind of interesting. So it looks like it looks at the it looks at raising rates as compared to home values. So basically,
Yes.
during these periods,
okay.
somebody mute? Oh, I guess I can mute them, I think. Oops. Yeah, there we go. So this looks at, again, the periods in which rates were rising, how much they increased, and then basically what houses did during that time. Okay, so we're not, yeah. So when rates are going up, that does not mean home prices come down. You know, we obviously are seeing price reductions now, you know, for a lot of listings, but I don't know that that totally correlates with home values as a whole going down.
Plus we were up like 20% since January. So
Yeah, exactly.
We'll still be at
Yeah.
that positive. Yeah,
Right,
sure.
right. So this is the home value forecast for 2022. So, you know, on the low end, NAR is predicting, you know, a 5.1 increase. On the high end, Fannie and Freddie are, you know, over 10% increases is their forecast. I think that's turning out to be a little bit strong, but obviously every market's different. So we live in a completely different market, you know, than the Midwest. My brother-in-law he worked for Caterpillar. They're based out of Peoria, Illinois.
Yeah, just moving.
And I just saw yesterday, and he lived there. So he lived in Peoria, Illinois from about 2016 through 2020. And his house went up in value by like 10 grand. He sold it for like 10,000 more than what he bought it for. I went on just real quick onto Redfin last night, and I looked to see the market in Peoria, Illinois, because I had never been there. We never went back and visited him while he was there, but that's the only game in town, right? Home values are based on jobs. So the biggest player in town now is going to Texas. So Peoria, Illinois is, you know, I mean, there's 5,000 square foot homes that are, you know, they would, you know, across the street would go for 2 million here in Renton, and they're, you know, they were, what were they, 375, 400,
Yeah.
4.25. But I don't know that those will sell. So at that price,
Just the economy can't support it.
the economy can't support it. It's not a big enough area. There's not enough, you know, other businesses to absorb that loss. So that's the biggest player in town. And, you know, just think about, you know, like in Snohomish County, like Boeing. Well, if you took away all of the high-tech jobs in King County, I mean, just think what, you know, if Boeing was the only guy in town,
Yeah.
you know, and they pulled out, what would that do to that area? You know, but you know, obviously King County and all the high-tech jobs in King County would support Boeing, you know, pulling out. So affordability index, this is an important one. So this is basically a measure of basically the median income versus the median home price. And if you can, so they measure it in terms of 25% of your income going just to principal and interest. Okay. So if 25% of your income goes towards the principal and interest payment, then then they give that a value of 100. Okay. So median income meeting the median home price. And right now we're at a 147. So even though, and this is a little bit old, so I'm going to say that the affordability index is down a little bit from here, but this slide isn't that old. But we're still definitely in the healthy category, even with rates up, because we've seen income increases. We've seen wage increases, you know, over the last couple of years by a good amount.
Do we have a slide for that?
I'm sorry. Nope, too
Awesome.
far.
Thank you.
That one. Okay, so the affordability index again, so they measure it by 25% of your income going to principal and interest, and they look at, again, at the median home price and the median income, and that perfect balance is 100. So again, we're definitely over 100 today, and if you're over 100, then that's healthy. So again, increase in rates, we're still in the affordable index category. Okay.
And is this for Washington or nationally?
This is nationally, and I actually I've got those numbers on my computer on local, and I'll have to send that to you. But I have those. I have that. I do have a. I pulled it off of a website yesterday and forgot to print that out. So it says we're still in territories, better than 2008. If you were back in the market during that point, we are in better shape.
Looks like Ross has been waiting to
Oh.
admitted there for a little bit.
How do
Just click on the blue
we
button.
right there? Perfect.
These are great charts.
So so this next one again, still again talks about that affordability, but basically it's showing that that about 17% today is going to that mortgage payment. What this doesn't show is we've been racking up a lot more credit card debt since the pandemic. So credit card balances are up significantly, savings is down significantly. So just because the mortgage payment is still in that healthy range, doesn't necessarily, some people are getting out of that healthy range in terms of their total expenditures on a monthly basis. Now, you guys have all heard about the shortage. This graph here is very, very, very telling. And it's the number of homes built in the US per decade. And you can see that in 2010 to 2020, we missed the mark. And that was basically because, going through the 2008 to 2010, I was in the business then. I don't know how many of you were in the business, but their builders they just stopped. They literally just stopped. Regardless of what stage that home was in, they walked away essentially. So there just wasn't a lot of building going on. And, there's really no way to get this caught back up, because if you think about it, we were actually on a call this morning with our previous CEO, and he said, they're announcing that we're about 3 million homes behind schedule. You're behind what we need, but in reality, it's about 3.7. So fact of the matter is there's not enough builders to get that number caught back up. So we're going to be lagging for a very, very, very long time. And the market that we're in here, obviously we've got limited land, right? We've got the borders of the water and the mountains. So we've got fewer places to build. Yeah. So that just kind of exacerbates the whole thing. So
This is great.
So 2021, so people's credit scores are going up. Now, part of that was because, people are getting smarter with their money, I guess you can say, to a point. But, during 2021, we did do a lot of, cash out refinance. So people were saving money, right? They got, so people got the stimuluses, they paid off some debts, with that. So that helped their credit scores. But what's this one? I don't think I have oh yeah, I guess in a couple of slides is the foreclosure. So people's credit scores going up. That just says that we're in a very, very, from a lending standpoint,
For foreclosures,
because, people try and compare, this housing bubble to 2008. It's an apples and oranges comparison. Because back in 08, in 07, when it really started, 689 versus, 731 now. So, So number of borrowers with credit scores less than 620. So you can see that that figure is way down. That just continues to talk about the strength of the mortgage market, and the likelihood of default is very low. Cash buyers. Yeah, this one was really surprising because I mean, I wasn't in the business in '88, but I was in the business about, well, in 95. So right in this area. Yeah, I don't remember there being that many cash buyers back then, but there were. Again, talking about the strong, basically housing market, or mortgages, but it just shows the amount of foreclosures. I mean, we're at an all-time low. Obviously, underwriting's tightened up, people's credit scores have tightened up. We've gotten rid of those, stated income programs and that type of thing, which honestly, I would have put money on it that those programs, those stated income loans where you didn't have to verify, I thought those would have been back in full force by 2015, just with much tighter criteria, because back in 08, you could do a stated income loan if you had a crappy credit score. So you had no,
Just like
yeah,
just a phone call.
yeah, it just, they basically, anybody that wanted a loan could get it. I mean, your rate was going to be different based on it, your credit score and if you could verify, but it doesn't make sense to me that, that you couldn't do a stated income loan. This was, again, go back to 2015 or whatever. Why wouldn't, some companies step up and just say, hey, we'll do a stated income loan, but it's got to be maximum 40% loan to value. And you have to have a minimum of 740 credit score, and you have to have been on your job or self-employed for 5+ years, and you have to have, and that type of thing. So
Freddie and Freddie Mac wouldn't allow that, I guess.
no, they've steered clear. Now there's some loans out there that, that different places have, different banks and mortgage companies have that are, kind of like stated income, but not really. But I just thought the full stated would have been back already. If you would have asked me in 2008, 2009, when stated income would have been back, I would have bet by 2015, just because, again, you could have made that a very, very safe loan for investors, but everyone just kind of kept their hands off, which is fine. It's just, some people in those scenarios lost opportunity just because they couldn't get any financing, even if they wanted to put 50% down, couldn't do it. Okay. Inverted yield curve. This is just kind of it's a number that gets thrown around, but it's just simply, or a term that gets thrown around, but basically it's a very leading indicator of a recession. In April, we essentially went, we went very close to inverted in April, and we're hovering there right now. I won't get into the full explanations of that, but it's interesting. If you were an investor, would you rather have your money tied up for 2 years at 2.5% or 3%, or would you want to have your money tied up for 10 years at that same? You would rather have your money tied up for a shorter period of time, because then, if you're getting the same rate, well, I'd want to get my money out in 2 years so I could reinvest it maybe in a different opportunity.
Yeah,
right?
Sure.
So anyway, when the short-term yield gets higher than the long-term yield, it's just every time it is an indicator that leads to a recession. So next one, just basically a graph kind of shows you, when it happened and then when the recession started. So when the inverted yield curve first happened, and then the last column basically is kind of that lagging time as to when that, when that recession kicked in. Now, remember, the definition of a recession is 2 consecutive quarters of negative GDP. Okay, the first quarter was negative. Okay, so second quarter is ending here in 2 weeks. So come, I'd have to look at the calendar to see when when they announced the second quarter GDP, but it's obviously in July. So at some time in July, we'll most
Officially be
likely,
in recession.
will most likely technically be in a recession. We're technically not there today. I think this looks like a duplicate slide. So this is basically, so these gray bars are the recession times. And then you can see again, to the right of those, you'll see that interest rates came down basically after the recession.
Great slides. Thanks for putting this together.
You're welcome. Basically home values during the recession, you're going to see that they went up, although, in 08, 09, that was different times. So different times, different issues. There were so many bad mortgages out there. I know people that, a friend of mine had 7 rental properties.
Also, remember the 0% down rental property?
Oh, yeah. Oh, yeah. So he had 7 rental properties, and he was only negative on like one of them. The rest of them were cash flowing. But they dropped in value by, 40-50%. So what did he do? He panicked. He let them all walk. Most of the foreclosures that happened during that time were strategic. It wasn't because people lost their jobs. It wasn't because their interest rates went up and they couldn't afford it. They just panicked. I had rental properties during that time too, and it hurt, but I'm like, well, they're still paying my mortgage. So I'm just, why would I want to let this go and lose, 100,000 or more from where I bought it from? And I held on to it, and I sold it 6 months ago.
Good for you.
Nice.
That's a good spot to be in.
So, again, these slides are just to give you, when you're talking to your clients, they're obviously scared. They're not sure exactly what's happening with rates and values and that type of thing. But this is just a research that's not coming. But yeah. Okay. So the next thing I wanted to show you guys is, I know at the office meeting, we talked about the, did you get one of these? You guys all got one of those? Okay. So I pulled this, so this is a listing in the office. It's been on the market for, and I am sorry, I can't remember whose listing it is, but up top here is the address. And it's been on the market for about 3 weeks. Okay. So let's talk about the opportunity here with this sell down. Okay. So if you look at this first column here, this 30-year fixed column, this is just, making the assumption that, that they're going to put 20% down. Okay. So paying full price, this is the list price. So just under $1 million, 20% down. So there's their loan amount, current rate, and so on. So total monthly payment, 56, almost 5,700 bucks. Okay. Now let's look at the next column, this price reduction. Again, this is a listing in the office here. It's been on the market, 3 weeks or so. Actually, I think it's almost been closer to 4 weeks that it's been on the market. So this listing agent is probably having that conversation, if they haven't already, right, with the seller. Hey, what are we going to do? Right. And that's not a fun conversation. I can assume on your guys' end that you have to have that conversation with the seller. Okay. So, but let's look at the price reduction. Let's look at what that does to the buyer. So if you drop the price by 50,000, which is obviously very realistic, ultimately what that does, that buyer is still going to put their 20% down. They're going to save $239 a month. So that 50,000 in price reduction essentially save them about $240 a month. Okay. Now that cost the seller 50 grand, right? Because they had to drop the price by 50,000. So the benefit to the buyer saves $240 a month, but that costs the seller $50,000. The next option is just a permanent rate buy down. Okay. So let's say that we leave the price the same, leave it at the $1 million. but the seller pays 3 points towards a rate buy down. Okay. So that rate buy down, sorry, I can't, for you guys online, I can't highlight this, but you'll see, well, I guess I kind of can. So it costs your seller half. It costs them 24,000 instead of the price reduction of 50,000. But look at what the savings is to the buyer. Saves them $526 a month. Okay. Everything is payment driven right now. I mean, with the cost of everything going up, buyers are very, very concerned about their payment. So anything we can do to get their payment down. So this is a strategy where you can go back to your seller and say, hey, you know, here's something that we can do to, you know, keep more money in your pocket and maybe attract some more buyers. So, you know, the strategy here would be to call back, you know, all of the agents that have been through the home, anybody that has shown interest in the home, and, you know, see if this opportunity would work. You would have to drop the price to equal the payment of this rate reduction. You would have to drop the price of the home by $100,000. So drop the price to $890, $240. That seller would still put, or that buyer would still put 20% down, but that's where you would have to drop the price to equal the payment of that rate reduction. Does that make sense?
Yep.
Yeah. So, so if you have your listing hat on, okay, you guys obviously work, you know, with buyers and sellers. So with your listing hat on, this is where you would go back to the seller and say, hey, we're working on a strategy to keep as much money in your pocket and attract as many buyers as possible. Dropping the price may not be the answer. And I think the sellers are going to like to hear that. I think the sellers are going to like to see that you've come up with a strategy to, you know, to possibly move the home, and it's going to cost them a lot less.
So they were at least worth the attempt before you.
Absolutely. It's worth the conversation. I would think that the seller would be appreciative that you showed them some options.
That's a great,
Yeah.
I would appreciate that.
Yeah, that you showed them some options. Now, on the, so now you put on your buyer, so now you're a buyer's agent, right? So it's the same type of thing. Now you're working with a buyer. Do you want to go in with your buyer and just have them lowball on the price? Or do you want to have your buyer go in and ask for some concessions, you know, and maybe it's a combination of both. You know, if you're going to offer 50,000, you know, lower for, maybe you actually only offer 25 less for the property and ask for 25,000 in a rate reduction. So you can contact, you know, any buyers that you've been working with over the last 6 months or what have you. And if they've gotten cold feet because of rates and because of payments, well, this is an opportunity to maybe get them back in the market.
Yeah, and with all the recent closings with bidding wars, we shouldn't have any problem with appraisals, right?
I know, I told people that too. I was
Yeah.
like, we're fine. We
We're
got
fine on
comps for
appraisals, yeah.
days, comps for days.
Comps
Yeah,
for days, and that kind of stuff.
Exactly.
So it's technically, so 1 point down, buy down, is that 1% of the loan amount or the?
So to get the rate down roughly by that 1% costs you, so it's about 3 points.
3 points.
In
Like,
fee.
each buy down point is the cost of 1%.
It's 1% of the loan
The
amount.
loan
Yeah,
amount. Okay,
yep,
that's what I
yep, yep. So the cost is going to vary because you don't know if the buyer is going to
Yeah,
put
yeah.
5% down or if they're going to put 50%.
Yeah.
Right? So,
Okay.
you know,
It'll
so
vary on each
so again, it's going to vary. But if you set your sellers up for that,
buyer. Sure.
Yeah.
and
for
you know,
sure.
and that type of thing. So now there's also a strategy, and I'm called the 2-1 buy down, and we brought that up at the meeting, and it's actually even more powerful. And the reason it's more powerful is because I think we can all agree to a certain extent that the rates that we have right now are temporary.
Yes.
You know, these interest rates are temporary. Now, how temporary? That's the
I
argument.
know.
Are these 6-month temporary rates? I think so, right? Based on what we talked about earlier about, inflation possibly peaking in the fall. So we think that it's, you know, that these rates are temporary. So with this buy down strategy, it saves them $526 a month, but you're still spending $25,000 in concessions, right? To save that amount of money. And how long are you going to have that loan? you might only have that. I mean, when are you going to be in an opportunity to refinance? You know, so they're at, you know, so they would buy the rate down to 4.95%. Probably going to have that loan for less than 2 years. Rates are going to be, you know, back into the low fours, right? Because if they're at 4.95, you're not going to, you know, we're not going to refinance them when rates get to 4.75.
Right.
But we're going to, once they get into the low fours, we're going to refinance them again, right?
Yeah.
And get that. So
It
rates.
take 5 years for that
Yeah.
monthly payment to make up the 25K, I guess.
So the other strategy is to do the 2-1 buy down. Okay. And I will send you, I'll email you one of these, same type of thing. And it's going to show you the 2-1 buy down. What the 2-1 buy down does is your rate 6%. But what it does is it allows you to have your first year's payment be calculated off of a 4% interest rate. So 2% below the prevailing rate, the going rate. Okay. So 6% is what you actually lock in your rate for. But in year one, you get to make payments based off of a 4% interest rate. Okay. Year two, you make your payments based off of a 5% interest rate. And then your rate is then 6% for the remaining life of the loan. Okay. Now, why is that a better scenario? Because, and the cost of that program is they calculate it to the penny, the amount of money that you're saving in year one and the amount of money that you're saving in year two, you total that up, that's the cost of the program. That's the cost of, so you're prepaying the savings. Well, the seller would be prepaying the buyer's savings, right? So
How much does that cost?
it costs a couple, it works out to be 2 to 2 1/8 points is where it typically works out to be. Okay. Now that money that you essentially prepay, that money sits in an escrow account.
That's what you were saying.
Okay. So that money is sitting there and that money is then every month, some of that money is taken out of that. Right. So let's just say that you refinance, let's say rates dropped and are lower 12 months down the road. And it makes sense for them to refinance. Well, 12 months down the road, they were at 4%. Now they've kicked up to 5%, but they're going to 6%, right? So now what if rates are at 4.5%? Well, it would make sense for them to refinance, but they've prepaid for 2 years worth of that savings. Well, anything that wasn't used just gets applied to it gets applied to their loan payoff.
Okay.
So if there's still $10,000 sitting in that account, then their mortgage payoff when they're doing the refinance gets lowered by, so they're not wasting that money, right? So they're seeing greater savings up front in a time where they're probably going to refinance before it would get to where that permanent rate buy down figure was. And when you do the permanent rate buy down, that money's spent.
Correct.
That money's spent. It's gone, right? You know, so the idea is if you're going to buy the interest rate down, the idea is you really probably want to keep that loan for a longer term, probably a good 5-year period, right? But the 2-1 buy down, again, it gets buyers even more savings in years 1 and 2, to help alleviate from the high interest rates, and they're going to refinance and get it down anyway.
Can you explain to some of the new brokers the difference between that and an ARM?
I was about to say, yeah, arms are pretty good right now too.
Yeah.
7-1s.
Yeah, they're getting better. The rates on the arms are coming down.
Yeah.
They're not
The
super.
spread's getting bigger.
Yeah, the spread's getting bigger. They're just a little bit lower than where the fixed rates are now. But adjustable rate mortgages are different than a 2-1 buy down, because an adjustable rate mortgage, let's just say a 7-year ARM. So the rate's fixed for the first 7 years, and then it adjusts for the remaining 23 years. So you can plan, you can budget, exactly where your payment's going to be for that, a 5-year period on a 5-year ARM, a 7-year period on a 7-year ARM. But a 2-1 buy down, again, is you're prepaying those savings up front. And again, if the seller can pay that could be a lot cheaper than a price reduction, and it can bring a lot of buyers back. And the 2-1 buy down, if you work out, if you work out a payment, you're going to see that payment on that, for that first year or two, that's not going to that's going to get some people excited, right? That's going to get some people excited because they don't have the competition that they had just a couple months ago.
Yeah,
And if you, to carry that a little bit further, if like just on this listing, this $1 million listing here, if rates were at 4%, if rates were at 4.5% today, what would that home get bid up to?
Oh, sure.
Point.
What would it get bid up to? Would it go to 1.1? I mean, it would go up by 100,000,
Well, they're
right?
4.5 in April. And that's
Exactly.
That's when it was going
Yeah.
bananas, right?
Yeah,
So,
yeah. So just a couple months ago, people would have paid 100,000 more for this property in a heartbeat.
Correct.
Right? So when you look at it and say, okay, well, you would have paid 100,000 more for it just a couple months ago. What's this with the higher interest rates? How much are you actually going to be paying in your mortgage payment for the next 2 years? Yeah, you're paying call it an extra $1,000 a month, for 24 months or probably less. But let's say that, the increased rates, hey, it's $1,000 more than where we wanted to be. Well, you're only going to be spending 24,000 in extra payments versus 100,000 in extra price.
And I wanted to just circle back to what we had talked about. The reason why this also works right now for the current market is we still have comps to justify the
Yeah,
$1
the
million
large
price point.
Mhm.
credits. Yeah. down.
Correct,
Yeah.
because if it was in a different situation, we
Sellers
were
would be more apprehensive to
correct,
like give a $25,000
Oh,
concession.
Oh, for sure.
Without.
correct.
Yeah.
Yeah, so
Yeah.
it's like that sweet spot
You're
right
totally right.
now.
That's a good point. Yeah.
It is, yeah.
For like
because
next
we
6
still
months,
have-
maybe, right?
The appraisals, yeah, the appraisals will still come in and support that even with doing a
Yep.
buy down,
Yep.
Yeah,
because-
that's a really good point.
that market.
You're right. Absolutely. So I think the 2-1 buy down strategy is, I know. I mean, that's the best strategy out there right now to get buyers back in the market. The buyers that have, stepped onto the sideline because of rates, this could bring them back.
Because the only struggle as a listing agent is trying to
We have to educate the
educate the
seller.
buyer's
Yes,
agent
and
of
the-
how this
yes,
is a better
and
bet
the
to your
buyer.
Yeah.
Yep,
buyer.
exactly.
Yep.
Yeah.
And I
Absolutely
think
right.
this was good. 'cause this
Great
really
tools.
kinda helps.
Yeah.
Yeah, great
Mhm.
tools.
And with this, with this seller buy down, I can attach a quick video.
That would be great.
Okay, so it's super fast and it's super easy for me to do. I pull this up, I hit a button, it's just recording, and I can explain it in 2 or 3 minutes. And send it to you. And then if you like it, if you think, it would help your seller or buyer for that matter, then you can just forward them the link and they can watch it as well. So it just, if everybody fully understands this, I think we can get some traction and get some movement.
Yeah, it's education. When you're like the innovator of something new, you gotta explain it, like 2280s and
Yep.
everything coming out.
Yep. And I've sent, I sent a couple of videos to an agent and I spoke to her, as an agent and I said, hey, go back to your seller. And, so that's how I was explaining it. She then, we talked after that and she's like, hey, could you record another one, but act like you're talking to the seller.
Yeah.
So I kind of took out some of those, strategy and, type of thing and just explained it again. But I kind of took out that part just so, because she was just like, I just want to forward it right to my seller. But the one that you sent to me, had too many things in there that, so I recorded another one at 2.5 minutes and sent it to her and it was done.
Appreciate that.
So.
Hey, Matt.
Yes, sir.
Matt,
Yes.
question for you. This is Teddy from the office.
Hey, Teddy.
So, so how would you recommend that we position this? Say if we're gonna get a new listing, do we just position it as something on the broker remarks, like add you guys as the preferred lenders, 2-1 buy down on the seller side? And if we're working with the buyer side, do we basically just ask for closing costs from the seller?
Yeah. So on the buyer side, you're going to ask for, a certain level of concessions, seller concessions. Okay. So it's going to be, it's going to be either a percentage that you're asking for or just a straight dollar figure. Okay. So you'd want to obviously talk to your lender
Okay.
to find out what that cost would be, just so you word that properly. From a listing standpoint, that's a good question. I don't know, how you could market it.
Put in the agent remarks. but-
You can put it in the agent remarks. But you know, I know the strategy that's obviously working right now is just simply calling the people that were interested in the property, going back to them and say, hey, our seller is willing to do, you know, to kick in this amount and look at what your buyer could do with the payment, you know, in terms of a rate buy down versus a price reduction. But in terms of advertising it out of the
Okay.
chute, that's a question that I think you guys would have to come up with that one. I have had some agents. I did a couple of these for some agents that were going on listing appointments because obviously, you know, a seller is going to bring that up. You know, hey, what if, you know, so hey, you know, things are slowing down. You know, what's our strategy? What are, you know, are we going to start at, you know, $1 million and then after a few weeks we're going to drop? What are we going to do? You know, but I think I've had some agents that have won some listings basically by showing this, you know, going on the listing appointment and showing that, hey, I've got a strategy up front. Reality is we're in a market where, you know, we may not get some offers, and what are we going to do? Well, here's something that we can, you know, advertise, or we can talk to the interested people about and save you some money. So this could be simply used to, you know, to get you some listings as well.
I think it's a great tool before you do a price reduction to exhaust all
Cool,
resources.
thank you.
Yeah, absolutely.
It's a great tool. That's a great
Yep.
idea.
I can put these together within, you know, it takes me 5 minutes. Plus the video. So it might take me 10 minutes total. You know, so if you guys are going on any listing appointments, if you want me to, you know, put one of these together, just so you have it in your toolbox, use it if you want. If it comes up, you can definitely use it. But yeah, just let me know. Any questions from anybody online?
This is good info. Thank you.
Excuse me, the colored slides. Good, okay. Okay, guys,
Well, thank you so much for putting that together, and
wish you guys were here. We have a bunch of sandwiches. If you're coming in later, they'll be in the lunchroom probably.
we'll disappear quite quickly. That's it.
How are you gonna send out those videos? Is it just by request?
So well, I attach a video to the flyer.
Okay.
So then they can see the flyer and then my pretty little face up in the corner. So, yeah, and it's just a link. So I just email you a link, they click on the link, this pops up with the, you know, with the video and it's done. So it's,
Yeah, that would be great. I'm
it's pretty
interested in
simple.
Yep.
Pretty simple. And again, you know, I can send it obviously to buyers too, right?
Yeah.
So if you have some buyers that are like, hey, yeah, maybe, you know, if you're talking to them about, hey, we should get back in the market, you know, tell me what their price point is roughly, what their payment is roughly, you know, where they want to be at, and let's, you know, put together a strategy so they can see it and understand it. That's all about, they got to see it and understand it. And I think if they see it and understand it, I think they're going to jump back in.
What is the best way to approach like giving them numbers with like removing liability from us, the agent? Like if I go, hey, this is the math I just did here, you know, obviously I'm not a lender.
Mhm.
What's the safest way to approach saying that?
The safest way would be for me to do something like this, you know, for me, you know, let a lender put the numbers together for you. You know, you can see on here, this has a quote date of 6/10. Okay. So I didn't account for rates on Monday because I thought they were very temporary. Today, so far was a good, you know, and I don't know what the market's doing right now, but so anyway, these rates were based on Friday's rates. But really, it's just, you know, everyone's situation is different. Everybody's, you know, wants their payment at a different amount based on the debts that they're carrying and their, you know, short, long-term goals. So it's just a matter of, to take the liability away from you, let me put the numbers together.
Okay.
That's all it takes.
That's what I was concerned about, is because I definitely want to mention this to my team and start doing that stuff. But it's like, also I want to be more prepared on, hey,
Yeah.
how do we actually go about
Yeah.
executing
Yeah.
this now?
So you know, and you'll get, if you don't already, you'll get the understanding on how this works. That's all you have to do is kind of have the understanding, but let me put the numbers together so you can then, you know, you can present the numbers to them and then we can answer their questions from there. But I haven't had anybody look at this and still be confused. You know what I'm saying? I mean, it's just, it seems like everyone that I've shown this to, gets it and sees some benefit. So,
You know, the worst case scenario, 3 points down, if you're at whatever your price is, and the minimum loan amount's gonna be.
Yeah.
Or maximum loan amount's gonna be at least, I guess, 3% less than that.
Yeah.
Purchase price.
Yeah, yeah.
That's really cool.
All right. All right, guys. Have a good one.
Thanks, Matt.
Thank you very much.
Thank
Matt.
you.
Thanks.
Later.
For you, like when you say do your own little sheet and video, then it's not you.
They should have been bouncing a little,
It's
doing a
like,
little something.
it's like trying to stop a
Yeah,
tidal wave.
freight train.
Yeah.
When
Yeah.
it's already crashing, instead of when it's
Yeah.
just like rippling in the ocean.
Yep.
Or yeah, a freight train when it's,
Yep, yep.
it's off the tracks.
Good deal. So